Welcome back. Hope you're having a good morning. Well, as we've been telling you, the global queue is a little bit muddled. Explains why the Gift Nifty is suggesting that we pull back a little bit at start itself. But plenty of stocks are going to be in focus. Dipan Mehta, director at Elixir Equities, joins us to help us out with a quick analysis. Hi, Dipan. Good morning. Tata Steel's numbers. Europe is showing signs that maybe a turnaround could be around the corner. Maybe by Q2, we could have a positive number just going by the trends. And the India business EBITDA per ton as well will improve. Last quarter's numbers are good. What's your view on the stock from here on?
Hello, good morning, and thank you for having me on your show. I think the numbers are better than what Street is expecting. And the key factor, of course, is how Europe performs. And I think they have made a lot of effort in trying to turn around the European operations. And gradually, the uncertainty around that is reducing. So therefore, going forward, we will have the full benefit of and the full growth rates will come from the domestic business where they are expanding capacity. And as I heard you on the show earlier saying that prices have gone up and costs have gone down, so we can expect very good numbers for the next 2-3 quarters or so. From that point of view, I think there could be a good trading rally in Tata Steel. But as I said, I'm not very optimistic on commodity stocks in the longer run. But I think these are traders' delights. And there's so much of information keeps on coming as regards raw material costs and finished products and volume. From that point of view, it's easier to make an estimate of what the profitability could be. But it's a cyclical business, and one should be careful what valuation you pay for such a business.
Okay, by the way, I was just looking at Edelweiss's response on a separate note. I mean, the RBI order that came in yesterday, and it's a cease and desist order on two of the Edelweiss entities, including ECL Finance. So looking at the responses coming in, for one, Edelweiss simply seems to be saying, this particular response is from Edelweiss Asset Reconstruction Company, that they will comply and they'll try and uphold the highest governance standards. That's on the asset reconstruction bit, where they can't take any more assets on board. For ECL Finance, where there were a lot of very serious issues raised by the RBI, Edelweiss is saying that this is with respect to the company's wholesale exposure. Last year itself, the company passed a resolution to discontinue this business going forward. So just some updates coming in. Dipan, hi, good morning. So RBI is as active as ever. I mean, actually, Edelweiss as a stock has kind of fallen off the radar as well. Any thoughts here or on any of the other NBFCs that still are yet to remediate some of these issues, whether it's a JM Financial or it's some of the gold loan companies?
Good morning and thank you. No, I think that it's when such action takes place, it's best to just wait and watch and see how it actually plays out. Edelweiss Finance per se is an extremely attractively valued stock. Recent performance also has been exceptionally good. And asset reconstruction is a good business, very high operating profit margins, good prospects, but volatility is always there in those earnings. And that business was scaling up pretty well. But as I said, I think whenever you hear of RBI action, it's best to just stay away from such stocks for the time being. Let the air clear out, let the company get back into resolution mode. Then one could look at it. At this point of time, I think it's better to go to the safer stocks. So amongst the NBFCs, what comes to mind is companies like Bajaj Finance and Cholamandalam, I think, which have proved the mettle and they have survived a lot of vagaries and volatility in the NBFC space. And now valuations are pretty reasonable. These stocks have really gone nowhere for the past several months or quarters, and numbers have come through. So we are seeing that the price to book and price to earning multiple also has certainly compressed. So I would go with the all-time performers, the bluest of blue chip NBFCs, considering that our entire outlook to the market is to be a bit cautious and go towards defensive.
Well, Dipan, I want to talk to you about shoe stocks because it's really, two very different steps, different pace, call it what you want. Look at Campus and what's happening over there. The market's obviously latching on to perhaps, maybe the worst being behind the company and the improvement we're seeing. And look at the wealth destruction on Bata. It's a telling story from levels of about 2,000, about a year and a half back or so. And again, we've got really lackluster numbers. What about the two?
Yeah, I think that clearly, makes a study for management consultants and management students on what went wrong in Bata and what is Campus Activewear. And you can add one more company to that list, Metro Brands. So Metro Brands and Campus Activewear clearly have captured the imagination of the investors and the consumers. And they have gone from strength to strength in terms of expanding their retail network and in terms of design, and especially focusing on the segments in the footwear which are done exceptionally well. And Bata, which had a good run for several years until maybe about 2, 3 years ago, seems to have lost its way around. I think brand also is getting a bit old and is not resonating with the consumers, is what my assessment is. But Bata remains extremely overvalued according to us. And the better way to play this particular niche retail investment theme would be through either campus activewear for metro brands. But our preference would be for metro brands because it has a more diversified, I would say, product base. Campus activewear is focusing just on sports shoes and athletic shoes. So there's that narrow segmentation over there. But these are great long-term stories, and if you buy them at reasonable valuations, they could turn out to be great multi-baggers as well.
Dipan, while all this chaos plays out, there are still companies which are reporting very strong numbers. And one of them, as I said earlier, is Samvardhan Motherson, right? I mean, good set of numbers, a lot of brokerage upgrades as well on the stock. But how are you feeling about that name now?
Yes, Sonia, I think exceptionally good set of numbers. And what are the best part of the company is that it is totally de-risked, irrespective of whether EVs take off or internal combustion engines do well. So because the products are such that they go in both type of vehicles. And clearly, I think all the acquisition which they've done over the years, that is paying off very well for the company. But look at 36, 37 times, a lot of the upsides have got captured. And one thing one needs to keep in mind that it operates largely in the mature markets. And their automobile sales kind of, don't grow at the double-digit growth rates which we see over here. So there could be a bit of a challenge in terms of growth rates going forward. Also, copper, which is one of their most important raw material, that those prices have zoomed up. I think last I checked 30%, up 30% year on year. And that could act as a bit of a drag on the margins going forward. But, with the time lag, the management does tend to pass on these cost increases as well. Great company, but I just, feel that maybe if it's available 15-20% cheaper on a correction, that would provide some amount of margin of safety and better returns going forward.
Okay, all right, Dipan, we're just getting some initial rates coming in, in pre-open, and Cummins is a stock that's going to be in focus. Those margins look blowout, at multi-quarter highs. They have a con call at around 10 a.m. But for the time being, I think the stock has opened gap up. It's already seen a big rally, but that stock as well is higher. Any view on Cummins? It's never been a cheap stock. The stock has already run up a goodish bit, but the stock, in fact, will be in focus because of those margins. Your take?
Yeah, Nigel, I think we've clearly seen this trend that all these MNC engineering electrical companies like Cummins, ABB, Siemens, Honeywell, 3M, they all have reported exceptional numbers. And clearly, the stock prices have zoomed up because not only are the numbers good and the investor sentiment has improved, but there's very low liquidity in these counters as well. These companies have very loyal shareholders. So, a little bit of institutional buying or concentrated buying does tend to drive these stock prices higher. But look, at 60, 70 times you buy on an up cycle, stock like Cummins, you really can't expect to, make great returns over the next 3-4 years or so. So better to buy them at a correction, no doubt, exceptionally good set of numbers, but wish you had bought the stock maybe a year ago or so. When they were anyway, it was quite evident that the business is starting to pick up and valuations were far more reasonable.
Okay. All right, Dipan, good talking to you today. Thank you so much for coming out and sort of sharing your thoughts with us.